They can't stop it. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the unexpected is about to send several major economies crashing simultaneously. And this is something we predicted on the show. What happened? The political elites are starting to scramble because they did not believe this was possible. We're going to show you what they're going to try to do to stop it. But when they're unsuccessful, well, the risk now is this is going to ripple across the world. And as we predicted, this is going to be the epicenter of the next global recession. Now, let's over to Bloomberg, where we picked today's story up with a headline is weak German economy pulls the Eastern European countries down. And this is exactly what we predicted would happen because the German economy is the manufacturing base of Europe. It is the economic powerhouse. And we have noted that the soft survey data showed it was at the very minimum in a recession, if not an outright depression. And that would eventually pull down the peripheral nations. And sure enough, as you're about to see, it is. Romania's gross domestic product unexpectedly contracted 0.4% from the previous 3 months, defying expectations for an expansion. Meanwhile, growth stagnated in Hungary and Poland. And again, you see the key word here is unexpected because not even the political elites realize that Germany's economy is so key to the rest of the Eurozone. And where it goes with a lag, well, everyone else must follow. The performance of three of the region's four biggest economies is the latest demonstration of how strongly their fortunes are tied to Germany. In fact, Europe's biggest economy is the main trading partner for the countries of the EU's east, accounting for between a fifth and a quarter of all of their exports. And for this year, the region will be looking to domestic consumers for a lifeline as weak external demand continues to be a drag on factory orders. And this is a problem in Germany, a huge problem, because what happens when you start to see demand in the factory sector go down? Well, there's one very important thing that happens first. That is hours of work drop. Then you follow a whole line of layoffs, and that will send, of course, Germany into a deep recession, if not outright full depression for their entire economy, and it will ripple right through all of those peripheral nations because Germany also enters a second post-pandemic year with an expansion anticipated to turn out feeble at best. We'll say they'll be lucky if they even turn any sort of expansion. We see private consumption regaining its strength as real wage or inflation wage growth, falling inflation, and monetary easing should support higher household spending. And this, of course, is from a Vienna-based economist. And that's the hope here, is that you see these experts look at the data and say, well, wages are rising. And that's true. One of the challenges here, they don't bother to look at how much people are working because someone can get a raise, have their hours cut, and get a smaller paycheck. So meanwhile, the political elites fixate on the fact that wages are growing, so something must be really good coming. Well, they don't understand why it's the end of the day, the bottom line paycheck that matters for everyone. And at this point, economic underperformance of German economy and the whole Eurozone is the key risk to the downside of our forecast. It's much worse than that. It's not just a matter of downside to forecast. It's a matter of sending the entire Eurozone in a recession. And if that happens, neither Asia or the United States or North America or any other industrialized economy is immune to what is happening here because we're already starting to see this happen in the U.S. And we can look at this chart here of the consumer price index in blue against total compensation because this is what the political elites overlook every time. And we look at not just average hourly earnings, but we also look at average weekly hours of production and non-supervisory employees. Multiply that together, put it on a year-over-year rate of change and color it blue, red. And what do we have? Blue, of course, the CPI. What do you see? A big plunge in total compensation from last month in the United States. And of course, eventually, when someone gets their paycheck, that leads to less spending. That's why we tend to see a lead where incomes and wages go, well, consumption follows. So here in the US, everybody's rejoicing that spending is going to increase. At the same time, we have ever valid evidence that total compensation is falling. That means, of course, even though the CPI index looked a little hot according to everyone's view, what's that with a lag? As you can see, the blue line follows where the red goes. And as we see, Eurozone stagnates at the year end as industry shows improvement. But one thing that should be showing a lot of improvement is your trading account, because if you had our reports, now you asked, you said, Steve, make them easier to use. And that's why right now on page 1 of CTA Timer Pro, where we look at the machine positioning, but we do something unique that no one else does. Not even the people that run the machines do this. We run a historical overlay, so when they are offsides, you will know. We show you these extreme positions. Plus, we have our technical analyst report that looks at all of those things like the RSI and the MACD and smooths that all out, makes it super easy for you. We put all the signals on page 1 of both. But let's take a look at a trade setup we haven't talked about on the weekly show, and that's agricultural commodities back on 12/18, our Momentum Timer Pro that looks at all those technical signals. We noted over a 1 month, it was at a max technical sell signal. And the 3-month wasn't far behind. And what happened? We saw a shift in momentum. There's a 1 daily buy signal. 4 days earlier, CTA Timer Pro was coming off a short position, telling us that everything here has changed. And even if you're just worried about chasing the equity indices, you can be diversified with our reports. That trade right now would be at 4.63%. Not much compared, of course, to what we see in the S&P and the QQQs. But here's the key thing. You can have multiple trades. We give you all kinds of signals every day. And here's the deal. 3 coupon codes for a free month for each of them. Links in the description below, because while Germany's creating, well, you should be profiting. And here you can see gross domestic product was unchanged in the 4th quarter from the previous 3 months, as according to Eurostat, meaning the 20 nation bloc narrowly avoided a recession following slight contraction between July and September. So again, looking backwards, this wasn't pretty. Meanwhile, industrial output defied analyst estimates for a drop by jumping 2.6% on the month in December. We noted a lot of that probably had to do with heavy machinery like aircraft orders. And while the result was in part thanks to a surge in Ireland, where data is often volatile, November's reading was also revised up. So are we starting to see now a turning point in, of course, the Eurozone, maybe looking backwards at Germany's finally coming out of the slump? Well, not so quick, because let's take a look at what happens here in the U.S. data. And what we can note is that industrial production against total compensation, when industrial production in blue tends to follow where wage growth goes. So you'll note that as people are earning less or their wages are rising at a slower rate, well, industrial production falls. And that's a real simple math to figure out here, because as people have less money, they consume less. They consume less, there's less new orders, less demand from the factories, and it all comes back to a contraction eventually in industrial production when you head into recession. But right now, we're seeing a little bit of a renaissance in industrial production. Meanwhile, an outright crash in total compensation. What this means is we're seeing a debt-fueled U.S. economy that is not backed by real wage growth. This is a huge problem. It will eventually come back in a matter of months. As we noted in yesterday's show, the data will eventually confirm this. But even as the euro area avoided a downturn, recent indicators suggest it isn't gaining much momentum due to elevated borrowing costs, weak foreign demand, and hesitant consumers. Now, here's the deal. If the economy around the world was strong, higher borrowing costs wouldn't matter. In fact, they would be highly justified. But the key part here is weak foreign demand. We continue to hear that from factory sector out of Asia. We're now hearing it out of Germany and the Eurozone, that demand around the world is weak. That is a problem, because it tells us the global economy here is slowing down. And how about this? Hesitant consumers? Well, you can't blame them. Their paychecks are getting smaller. Then why would they go out and spend? They don't like the trend here, because when you start seeing your hours cut, you know eventually that means somebody hits the unemployment line. And the labor market has remained surprisingly resilient. That is the hope of every political elite and central banker around the world in the face of such weakness. Employment grew at 0.3% in the 4th quarter, even better than it managed in the previous 3 months. But will that last? Well, the answer to that question is absolutely not. Because what happens when you see total compensation growth fall, particularly when it's led by a cut in hours worked, it means that layoffs are coming soon. So you think about it from an employer's perspective. They're seeing their new order book shrink down. There's not getting a lot of demand on the new side. They've got an existing book of orders, and they're going through and they're clearing those down. And next thing you know, you start to see that you don't have enough work for your employees. So what do? You start cutting a few hours here, a few hours there, sending people home a little early. The problem is, when the new order book doesn't fill up, well, some of those people are going to stay home permanently. That's what the political elites really can't see here, but the evidence is very clear. As we look at total compensation growth, we see it slowing down here in red, and you can see this going into virtually much every recession. What happens? It's matched by an increase in continued unemployment claims. So again, people get unemployment and then can't find a job. Well, there's no need for them, and here you can see that happens again going into the dot-com bubble, the global financial crisis, and now we're seeing again this big drop in total compensation will ultimately should be matched by an increase in continued claims, and that's something neither the Fed nor any central banker wants to see at this point, because what it also means is inflation is coming down in a big way. And such strength is keeping the European Central Bank officials on edge. Well, it should have them cutting rates, as the tight jobs market and quickly rising pay could delay inflation's return to the 2% target. Again, they're missing the boat on the hours worked here. They're keeping policy too tight. What the issue here is, they're going to be faced to cut and cut rapidly, but it will be too little too late, because once you see all these economies start to enter a recession, it's going to ripple across in terms of demand to other industrialized nations who are going to have no choice but to follow them down. But do things in the U.S. look a little bit better? Well, the Chicago Fed's got a new index here, and they're saying demand is rising. But for long? Well, we'll see. As the new Chicago Fed index sees more moderate gain in January retail sales, with everything poised to the U.S. consumer. Of course, one thing we know is where the stock market goes, the U.S. consumers tend to spend. When we see that decouple, when you see stocks rallying and consumption fall, it tells you things in the U.S. economy are outright broken. But the Fed's trying to get a better pulse on this, as the index estimates that retail sales, excluding motor vehicles and parts, will rise 0.2%, in line with median forecasts. That will follow a 0.4% increase in December. And meanwhile, the Chicago Fed's new measure aims to track consumer spending by using high-frequency indicators. I know some of you are shocked by this, because wait, the government's actually trying to give us a real-time pulse of the economy. I know, it's actually unbelievable. To allow for a direct comparison to the Census Bureau retail and food services sales, excluding motor vehicle and parts data, which we can note is lagged, inaccurate, and of course, more importantly, not inflation adjusted. The measure grew out of pandemic-era research that aimed to improve on the timeliness and reliability of traditional measures of retail spending in the U.S., according to the Chicago Fed, suggesting that what the government puts out is absolutely garbage. No surprise to that. Overall, the 8 data series are combined into a single gauge. In addition, the Fed Bank will include an inflation-adjusted estimate that is actually super powerful, that's currently not provided by the Census Bureau. Chicago Fed also projects a 0.2% increase in sales, excluding autos, after adjusting for inflation, which would be a big bit of a jump, particularly since it matches the increase of what's going on here in the equity markets. Granted, excluding yesterday's big drop, the trend of the equity markets higher. When people feel wealthier, they tend to spend more, but are they really spending a whole lot more? Well, not so much. As we look at total compensation, which is again plummeting straight down here against advanced retail sales, what we can note is generally they go in line together, and it makes sense. As people have less money to spend, or they're seeing their pay increase at a slower rate, well, what do? They turn around and they spend less, they consume less. It makes perfect sense. This is why during the pandemic, when people got all that money from the government, they had money to spend, and they did. But reality is back. In fact, there's only one time that I can know where we see total compensation growth slowing and retail sales rising. And it took quite a while. It took, in fact, almost 2 years for that to turn into an increase in total compensation growth. The question now is, can retail sales defy this trend of normal move where we will see a rising retail sales against falling total compensation? Well, if we adjust it for inflation, that being the blue line of advanced retail sales, it doesn't look that great. It looks like a bit of, we noted in the past, a move based on expansion of credit using credit cards, buy now, pay later. The question is, as people start seeing their paychecks shrink, will they cut their spending? My prediction is yes. Now, what does also all they mean for the ECB? Well, it means they need to cut rates, but they don't need to curb demand further to tame prices, as this Italian official speaks for the first time on monetary policy. He's got it right on that effect. With demand still weak and inflation expectations anchored, There's no need for monetary policy to generate further slack to keep inflation in check. What he's starting to say here is, wait a minute, we're starting to figure out that demand is actually now falling below supply. That means inflation starts to cool off, price increases start to slow down. That is exactly what is happening. The unwinding of supply shocks creates scope for demand to recover without fueling inflation. That is exactly what we'd expect to see here, as lower energy prices now create scope for some wage catch up, especially if profits normalize. But remember, profits can't normalize if you see price growth go down. Companies have to get money from somewhere. So either they lay people off and get other people raises. But again, if the consumer price index starts to normalize and flatten out, there aren't going to be big wage increases here at all. But it will ultimately be a combination of these dynamics that determines whether inflation converges durably to our target, he said. This is why we need to remain data-driven as we consider our next monetary policy decision. The only decision should be to cut, because here we look in the U.S. as we talk about energy, we had a massive build in crude oil inventories, 12 million barrels against a 3.7 million barrel decline in gasoline and a 1.9 million barrel decline in distillates, suggesting, as we've noted, that product inventory levels have been fairly high here. The refineries were likely to cut back production. Now we're seeing oil start to build up. And if you look at total compensation against West Texas Intermediate shown in blue, well, it tells us that as people see their wage growth continue to decline, their total paychecks get smaller. What that means is demand for energy should plummet. We should see energy prices go down here, not up. Of course, as we know, that ultimately backfeeds back into the CPI over time, leading to less inflation and, again, a slowing economy, more layoffs, and central bankers ultimately chasing the zero band again. And with that, I'm Steve Van Metre. Have a happy Valentine's Day. As always, thank you for being a fan. Bye now.